Welcome. Today's financial wellness webinar is the last in the 2024 year-long series of educational webinars. We'll be taking you beyond the 401k and we'll be reviewing both ways you can use your retirement accounts to save for your future, as well as exploring additional saving strategies you can use to help reach your financial goals. So take a minute and picture exactly what you want your future to look like, and get ready to learn a few strategies that can help you get closer to living your full and best life ever. Thank you. Every day we have the privilege of working. Oh, I'm so sorry. I'm sorry, hold on a second. Okay. We're going to specifics today, digging deeper into ways you can take full advantage of saving opportunities. We'll cover both making your 401k work harder for you, as well as using other saving strategies available to you. Again, we encourage your questions, so please use the Q&A and chat box to share your thoughts. We'll try to get to them at the end of the webinar. Many of you already know me or one of my colleagues. Maybe you joined our quarterly webinars before. We are Retirement Solution Group, the 401k consultants on your employee retirement plan. But who are we? We are retirement specialists. We simplify complex decisions in a highly regulated industry, provide creative solutions, and tailor a customized plan that supports both the organization and employees. In other words, we are your 401k geeks resource group. You have a question or issue, we have the answer and solution. Every day, we have the privilege of working with over 700 business retirement plans throughout the country, helping over 24,000 people just like you save for the future. Although every business is unique, there are some commonalities at the core of everything we do. We believe that education is power. We start by listening to our clients' needs. We know that empowering people with the knowledge and how retirement accounts work, the benefit of saving for retirement, and how to set a financial path to follow will lead them fulfilling their retirement dream. While RSG's focus is on your retirement benefits, we know that this is only part of your total financial picture. So today we bring in some backup. Rise Private Wealth Management is one of our partners who pick up where your retirement benefits leave off, advising you on financial wellness and personal financial planning. We have partnered up today to bring you the best of both worlds and share with you a few smart saving techniques to fit your needs and future. Before we go any further, let me pause to formally introduce myself. I am Elvia Sanchez, a certified plan fiduciary advisor at Retirement Solution Group. And I have had the pleasure of meeting many of you when I go out to your work location. And I'm happy to share my knowledge and experience hosting today's educational webinar. But also, I am available throughout the year as additional questions, issues, or changes arise, as well as my team. Typically, I spend my days helping employees understand how to take full advantage of their employee retirement plan, no matter their savings goals, the amount of their paycheck, or the company they work at. I always share a few of the most important savings tips. Remember to take the time at least once a year to log on to your 401k and review how much are you contributing? Is it time to increase? Am I utilizing pre-tax or Roth? What makes the most sense for me? What am I investing in? Does it still make up the retirement? Does it still make up my retirement time frame, risk tolerance, market conditions? Please lean on us. We are here to help you as you begin your retirement journey, are in the thick of it, or when the time comes for you to start enjoying your retirement. Sorry. So, oh, there you go, thank you. Take full advantage of your 401k plan. We need to go one slide back. Thank you so much. All right. Next, I think the best thing for you to do is work with your spouse or partner in achieving your financial goals. I am sure your spouse will help you spend it at retirement, so why not have them help you save it up to get there? If you're maxing out your 401k and can save additional monies, have your spouse max out their 401k. Individually, you can each save this year $23,000 for those under 49 years of age, or $30,500 if you will be 50 this year or older. This amount will go up next year by $500. Utilize your retirement accounts to lower your income for the year if needed by deferring the pre-tax. But most importantly, make sure if you have employer contributions that you are each contributing enough to receive the company match. Don't leave money behind. Be greedy and take that additional money to help grow your account. So I always tell people, look at what that employee contribution is. If they're asking you to put in 6% and the match is, so you could get the match of 50%, do it at a minimum. It's free money. There's no investment that we can ever guarantee to have whatever that match is contributing for you as a return. So I say, take it in, don't leave money on the table. It'll help grow your account and put you in a better position for the future. That's what you can do with your retirement plan. Now let's talk about beyond your 401k. As I mentioned, today we're teaming up with Rise Private Wealth Management. And I am calling on one of my most trusted private wealth advisors from Ameriprise Financial, Shanna Deshay. Shanna helps hardworking people who have big aspirations for financial security to go further and faster with a team of financial experts by their side. She's going to take you through a few simple strategies and tactics you can take to start saving for the future. She'll get you thinking about what other saving needs you have and what other types of accounts you can utilize. I'm pleased to introduce Shanna Deshay. Sorry.
Thanks, Elvia.
You're welcome.
Good morning. Thank you for having me. Before we kick off and dive into the accounts discussion, I just wanted to share a little bit about the Rise Private Wealth Management team, our vision and mission. So our vision is to be the most recognized and referred wealth management firm in the industry with a strong community presence, bringing financial advice that delivers confidence, simplicity, and success. So we know, just like RSG, the world of finance can be quite complex. So we just really are the resource to our clients to make sure that you understand and you have confidence in the financial game and the game plan and the decisions that you're making, so that when you achieve certain goals, you know what that next goal is that you're working towards. I know that it's hard to work every single day and feel like you're treading water, but when you can see the goals being achieved along the way, it feels that much better. So I'm happy to be here today, happy to be able to present in the communities that you live and work in, and happy to be a partner to RSG. Okay, so before we get started, I think it's important to discuss the tax control triangle. So what this represents is how dollars in various accounts that you save into are taxed. So every time you save a single dollar, it actually lands in one of these three different triangles. The difference is simply how those dollars are taxed, both the way that they're taxed on the way in versus the way out. So we'll talk a little bit about different accounts that are funded on a pre-tax basis that receive tax treatment on the way out. We'll also talk about accounts that you can fund on an after-tax basis, but are tax favored on the way out with no tax applied. And then we'll talk about different accounts that you would fund on an after-tax basis that do have some taxation along the way, as well as when you distribute. So we'll dive into a few various accounts. And as Elvia said, if you have questions following, we are happy to be a resource to you. So first we'll start with pre-tax accounts. So think your 401k as well as your traditional IRA. So these accounts you're typically funding on a pre-tax basis. The accounts are tax deferred, and so you're going to benefit along the way from growth and not paying taxes. However, when you get to retirement, you will pay taxes on the distribution, so dollar for dollar. Now, when it comes to 401ks, think 403bs and the like, these are accounts that you're funding through your employer paycheck. So the contributions are coming from your paycheck, different from the traditional IRA. So a traditional IRA, you would fund from your bank account. As far as the difference in contribution limits with 401ks, as Elvia had stated, it's adjusting typically every year, but for 2024, you're limited to a $23,000 contribution into that account. I'll talk about catch-up contributions here in a minute, whereas a traditional IRA has a much lower contribution amount at $7,000. Now, why you might consider a traditional IRA in addition to the 401k is if you've max funded that plan and now you're looking to grow your retirement bucket in an additional account, traditional IRAs are a good option. As far as catch-up contributions with the 401k, as long as you're 50 or older, you have the ability to save an additional $7,500 each year. With the traditional IRA, that additional catch-up contribution, just like the traditional contribution, is going to be a lot lower than your retirement plan through your employer at $1,000 for the catch-up. Now, when it comes to withdrawals, there are some opportunities for individuals to access the retirement bucket before their retirement age. These examples are if there's a hardship, if you're a first-time home buyer, and then of course, if you leave your employer, you can roll your plan over to your new one. So 401ks, traditional IRAs, pre-tax accounts can move between like accounts. With these saving strategies, the 401k, anyone can contribute to the 401k regardless of the income that you make. It's different from a traditional IRA, where the point of contributing to a traditional IRA is typically because you're going to take that tax deduction for doing so. But there are IRS income limits that are applied to allow you to be able to take that deduction. So you'll just want to make sure that you're working with your financial professional to make sure that you're eligible for those. And then as far as distributions and how these differ, they're very similar when you get to retirement and you're ready to start that income stream. What you'll want to be aware of is making sure that you're not distributing before age 59 and a half. And the reason being is there is an early withdrawal penalty of 10% that gets applied in addition to these dollars being fully taxable. So typically we want to make sure it's at the point where you don't have as much taxable income showing up, and that therefore it makes sense to start drawing down from these accounts. As for any retirement accounts, when you get older, there is an IRS mandated required minimum distribution. As of right now, that age is 73. So the IRS will apply a required amount that you have to draw down. So even if you have other sources of income, based on the pre-tax amount that you have saved, you will have a calculation that tells you what you have to distribute each year. And then the difference between the two accounts is between a 401k and a traditional IRA is also who maintains the accounts. So of course, your employers are providing you with that 401k plan, partnered with RSG and some great professionals on your side. If you decide to open a traditional IRA, you will either have to open that and manage it yourself or work with a financial professional via like a financial planning relationship to help you manage that account. So some differences there between the two. Now moving on to some after-tax saving strategies. So a Roth IRA is an additional opportunity for you to save, again, once you've kind of max funded that retirement plan. So with a Roth IRA, you're able to contribute to these accounts on a tax-free basis. And the whole point of doing this is you're now saving on a tax-free basis, and this is that account that landed in that top triangle, where when you get to retirement, you can access the contributions and all of the growth on a tax-free basis. So in addition to kind of building and diversifying your retirement paycheck from a tax standpoint, you're also able to further diversify yourself from an investment standpoint. So within the 401k that you have at work, you'll have certain investment options, where with a Roth IRA and a traditional IRA, you're able to invest in different investments. So there are some alternatives that you would have access to. But again, making sure that you're saving in your retirement plan that's provided through work first, and then looking for some secondary savings. Roth IRAs make a lot of sense. And unlike a traditional IRA and the pre-tax 401ks, the IRS does not apply a mandated required minimum distribution to Roth IRAs. So you're able to defer accessing them until you actually need the dollars from the Roth IRA, which can be really impactful when you're in retirement and needing to kind of maneuver that tax return. Any given year, you can take a little bit out of the Roth IRA if you don't want to spill into that next tax bracket. Now, when it comes to Roth IRAs, you do have some income eligibility rules. So if you make too much, you're unable to contribute to a Roth IRA. Different from a Roth 401k. So if you have a Roth 401k, so it's the same 401k, you would still log into the same account, but rather than making your contributions on a pre-tax basis, you can make them after tax via the Roth bucket. You do not have the income rules that apply to a Roth IRA. And the importance here is just getting started early so that you can build a nice, healthy Roth bucket, especially with the limits being so low. Via the $7,000 limit each year to be able to contribute, you'll want to contribute ongoing to really build an amount that compounds over time so that you do have that diversification from a tax standpoint when you get to retirement. So the health savings account. So we'll talk about the health savings account and the traditional use of a health savings account, but we'll also talk about using a health savings account as an actual retirement savings strategy. So with health savings accounts, each year there is a contribution limit. For 2024, that contribution limit, if you are on an individual plan, was $38.50, and then $77.50 for families. There is also a catch-up contribution amount of $1,000 once you're 55 or older. And something that few individuals are aware of is even if one spouse holds the family plan and is making that $1,000 catch-up contribution, if the other spouse is 55 or older, they can actually open their own HSA. They can't contribute the $77.50 that's for the family because you as the holder of the plan can do that. But what they can start doing is building up the extra catch-up contribution each year via that $1,000 contribution. Now, when it comes to a health savings account, it's actually the only account that is triple tax advantaged. So you get a tax deduction when you make the contribution. While the account is being held and possibly invested, which we'll talk about, the dollars will grow tax-free. So you're not going to receive any interest 1099s or anything like that along the way. And then if you hold off and you wait and access it in retirement for medical needs, you can access all of the contributions and the growth completely tax-free. Now, why you might consider utilizing an HSA not for just today, but for tomorrow is unlike FSAs, HSAs are not a use it or lose it account. So you're able to actually make the contribution every year, say thank you very much for the tax deduction, and actually not use it. So instead, the thought process is let's save the money, get the tax deduction, but let's use earned income along the way to cover medical so that when we get to retirement, we actually have these dollars that we've gotten the tax deduction for, but have those dollars set aside to help us pay for medical when we aren't earning income anymore. And along the way, you can get into the HSA accounts and actually get those dollars invested. So a great strategy to be able to really build up some dollars for retirement bills or medical bills, because what we know to be true is it's one of the largest line items for retirees. Now, something to consider is you can only contribute to an HSA if you're on a high deductible medical plan. So you'll first want to make sure that you're enrolled in that plan, and then you can pair it with an HSA. And then also be aware that if you take money out of your HSA for a non-qualified withdrawal, meaning it's not for medical, before age 65, you will incur some penalties. Okay, so now let's talk about, we funded our retirement account through our employer, and we've made contributions to either a Roth IRA or a traditional IRA. Now we have additional cash flow. What do we do with it so that we make sure that these dollars are being saved in a meaningful way? One option is taxable brokerage accounts. So when it comes to these types of accounts, there are no contribution limits, and there are also no income eligibility rules. So you're able to open a brokerage account and invest in the universe of investments. So stocks, bonds, exchange traded funds, maybe you like some alternative investments, maybe you want some exposure to annuities, whatever it might be. You're able to open these accounts and not have your hands tied as far as what you can contribute and what your income will allow you to contribute per eligibility rules. Additionally, there are some capital gains favorable tax treatments that are applied in these accounts. But what you'll want to keep in mind is, as you're investing, kind of understanding how those investments individually are taxed, because you might have now exposure to interest and dividend tax. You will have capital gains treatment. So recognizing the benefit of holding positions for a little bit longer versus selling them sooner and having them recognized as ordinary income. So although this is a benefit to be able to save into these accounts and it offers some diversification, you'll also want to make sure that you understand the different tax that is applied in an account like this. With that being said, because you get taxed here and now, there are some strategies that you can implement, like tax loss harvesting and direct indexing, meaning that you're getting an investment in individual positions that make up an index and able to make tax strategy changes throughout the year to really harvest some losses so that you can future offset some gains. So lots of tax strategies are implemented in these types of accounts, and you can get exposure to investments like municipal bonds that have more favorable tax treatment, foregoing the federal tax, income tax on those, and sometimes even foregoing any state income tax, depending upon what that municipal bond is. So another option to be able to save more and utilize some tax strategy. All right, now we'll talk about some additional saving strategies outside of retirement accounts. So the first is charitable giving strategies. So depending on if you are or are not charitably inclined, there are some strategies that could benefit you. So one example is you could bundle several years of gifting and open a donor advised fund to be able to take an upfront tax deduction for doing so. Along the lines of giving strategies, maybe it's not to a charity, but maybe you want to start gifting some of your money to loved ones. There's an annual gift limit each year that you can make without incurring any type of gift tax. Right now, that's $18,000 per year per individual. So really considering some gift strategies could be helpful longer term. Equity compensation plans. So taking advantage of that plan if it is offered through your employer, and then making sure that you have a game plan to be taking advantage of those shares ongoing to make sure that it's in alignment with whatever financial goal is next on the list. Permanent life insurance. So utilizing permanent life insurance is another diversification tool. Typically individuals think as life insurance just for, the protection side, protecting a loss of life, but this can actually be utilized as a tax advantage saving strategy, both for you and to be used as a legacy vehicle. So something to consider there. And then real estate. So thinking, your typical real estate, maybe purchasing some commercial real estate, building a portfolio there, but then you could also purchase real estate investments inside of a brokerage account. So getting some exposure to the real estate industry, but not actually holding and having to be that landlord or hire a maintenance company. In addition to all of this, so everything that we talked about today, you want to make sure you're finding balance with making sure that not only do you have a saving strategy, but you're addressing debt along the way. So there's always balance in savings and saving in one bucket versus another, but always keep in mind that along the way, you want to make sure that you're always addressing that balance sheet.
So thank you, Shanna. That was great. Today you heard about teaming up with your partner and maximizing your retirement account, as well as incorporating accounts to enhance your portfolio. Give each of your accounts a purpose and a role as you start implementing them, and giving a date of usage. As we have learned, some of these accounts can have some great tax advantages as long as we're utilizing these monies when the monies are supposed to be coming out from these accounts. Consider your 401ks, right? 59.5. But well, it could have some disadvantages if you're utilizing these monies beforehand. If we can move one more forward, please. Thank you. So Shanna's here, and I want to thank her for joining us today and giving us some good ideas and other saving options that we utilize in combination to our 401ks. You are welcome to sign up for an initial complimentary consultation with her. The sign up QR code is here in front of you, right? You will discuss your goals, where you stand, and areas she believes she can help you. I'm going to check the Q&A box one last time to make sure we addressed any concerns and give you any information. Give me 1 second. Okay, one question here, Shannon, for you is, if they are utilizing their 401k and maxing out, can they also utilize IRAs and Roth IRAs as well?
Yes, yep. So the contribution limits are particular to the actual account itself. So when it comes to the 401k, you'll have that $23,000 limit. If you're 50 or older, have that additional catch-up contribution, which, by the way, the catch-up contribution for those between the age of 60 and 63 is going up in 2025. So make sure you're connecting with your account representative at RSG to make sure you're taking advantage of that increased amount. But so that is separate, only in particular, only to the retirement plan that is provided through your employer. Separate from that, you can contribute to a Roth IRA or a traditional IRA or a combination, but that maximum contribution would be that $7,000 that I had quoted, with the additional $1,000 contribution for catch-up if you're 50 or older. But it can't be you have a traditional IRA and a Roth IRA and it's $7,000 for each. It's a combination between those two. And just be sure that you're checking the eligibility rules around contributions to those accounts, and being able to take that deduction in the traditional IRA.
Actually, we have 2 more questions, and then we'll try to keep it close to that 30-minute time frame. Do I have to use all of my healthcare savings account before I leave my current job, or can I take it with me and spend it down after I've left my current job? What happens to the money I don't spend on my annual healthcare bills?
Sure. So just want to call attention to HSA, not FSA, right? So with a flex savings account, you are required to use that every year. With a health savings account, you can roll that over and you can actually take the health savings account from one employer to another. You can actually keep the health savings account if you wanted, even if you start a new one with the employer. But typically we say just merge them so HSA dollars can get merged with other HSA dollars. And the goal, of course, would be, you get the tax deduction now, but is there any way to kind of challenge yourself to not utilize it and save it? Because later on, what we know to be true is in retirement, you'll use those dollars.
Yep. Last, I don't have a ton of extra money for buying stocks or having a brokerage account, but I have a little. Is there a dollar amount when buying stocks that makes sense?
Yeah, so there are actually minimums that are required depending upon the type of fund that you want to get into. I can share some of those details depending upon the type of investment you're looking to get into. But typically, if you set up an account and you set up like an ongoing, so a systematic contribution to an investment, it's a much lower upfront requirement. But again, it's going to be particular to the type of investment that you're making. And, just to that point where you're saying you don't really have that much, you'll build it over time. So even regardless of what you have, save earlier, save sooner, and it'll really start to compound and grow for you.
Awesome. Last question, actually regarding 401k in the States. When maxing out my 401k and my spouse's 401k, Are the employer contributions part of the IRS limit? And are we both allowed to max out to the IRS limit? Yes. So the answer is yes to both. Sorry, no to your employer contributions. Your employer contributions are not part of the calculation when it comes to the amount of money that you are contributing into your 401k. If you are the age 49 and under, the maximum amount you could put in is $23,000. Your spouse can put $23,000 away. So in putting that money together, both of you guys are putting $46,000 away, right? If one of you or both of you are over the age of 30, then it's $30,500 one spouse and $30,500 the other spouse. Whatever your employer contributes to for you, that is on the side, is not part of that maximum amount that the IRS allows us to put away into our 401k. So, thank you so much for the questions. Those were great. Thanks, Shanna. That concludes our questions for today's webinar. Your RSG team is always here to help you. Feel free to contact your RM with any questions. And if you are looking to set up a group education meeting for your group, please let them know. They'll be happy to customize one for you. We have created resources for you. There are 2 codes out here. And if you want to take out your phone, one code is the resource for RSG's Knowledge Library, and it's full of educational articles and videos to help you understand your 401k, or simply reach out to either me or our teams, or you can use the additional QR code to contact us. Thank you for joining us today for a quarterly educational webinar, and I hope you were able to take away at least one idea that can help in building out your financial plan. Please have a wonderful day, and we hope to see you next time.